Welcome to Real Estate Coaching Radio, starring award-winning real estate coaches and #1 international best-selling authors, Tim and Julie Harris. This is the #1 daily radio show for realtors looking for a no BS, authentic, real-time coaching experience. What's really working in today's market, how to generate more leads, make more money, and have more time for what you love in your life. And now your hosts, Tim and Julie Harris.
Welcome back. Today's Friday podcast is something really extraordinary. We have Keith Jensen as someone who's going to be filling your heads with all things Fannie Freddie. Now, don't worry, this is not going to be some droll discussion on lender qualifications and ratios and all the rest of that. Nope, this is going to be talking about something that's directly relevant to your ability to transact, and that is your borrowers' abilities to get loans, specifically as pertains to the release of Fannie Freddie from conservatorship. This has been a sideline topic for most of the industry for a long period of time, but you watch in the next 30 to 60 days, based on what we see happening, it's going to be on everyone's minds. When is Fannie Freddie getting released from conservatorship? What's this going to do for the availability of mortgage and mortgage interest rates and mortgage qualifications? All of this is about to change, and this will have, including the reduction of potentially PMI costs and the actual reduction of mortgage interest rates. If Keith's thesis, what you're about to hear, is correct, you're going to see a sea change in how mortgages are done in the United States for the better, and you're going to see a pretty significant increase in the number of borrowers that can actually obtain a mortgage. I do want to let you know that Keith is a partner, or we're a partner with Keith and his fund. So Julie and I are investors. You're going to learn a little bit about his fund at the end, but I have no dog in that fight. If you do or don't invest with Keith, it doesn't have any bearing on the information that you're about to learn. Let me know what you think in the comments. This is something that is a little different for our podcast, but I know all of you guys are ready for it. And here we go. All right, let's go. Keith Jensen, thank you for being my very special guest today. I have been trying to get Keith on our podcast for quite a while. You guys know we've been reporting about the whole Fannie Freddie conservatorship issue on and off for years. And, it wasn't until Julie and I ran across Keith that I really started to understand from all sides the complexity of this issue. Now, why is this relevant to you, fellow real estate agent, fellow broker, and all the rest of it? Is because what could be about to transpire with the conservatorship ending for these giant mortgage entities, essentially, it could really transform the industry in very positive ways. And so Keith has, like I said, educated Julie and I. A lot of what you've read in our articles and our other podcasts, frankly, we got the information from Keith. So without any further delay, Keith, thank you again for meeting with us today.
Delighted to be here. Thanks for having me.
So can you give them a little bit of background? Just let them know a little bit about really what makes Keith Jensen the legend that you are.
Oh, that's too kind, way too kind. I'm a 34-year attorney, and what's most relevant to today's discussion, in all likelihood, is I did The Big Short in 2006. I met my still friend today, Kyle Bass, and I invested in The Big Short. So what was I investing in? I was investing in, unfortunately, betting on the first downturn in real estate values in American history, and the largest foreclosure rate in U.S. history. And unfortunately for the real estate market, we were right in The Big Short. And you might have mentioned, Tim, in full disclosure, I do run a fund that's asymmetrically long the recapitalization and release of Fannie Mae and Freddie Mac, and we call it the virtuous sequel to The Big Short, because it is. And the reason it is because a going long Fannie and Freddie, if you will, provides the opportunity, as I hope we get into, for the significant amounts of money available to Treasury to be utilized to solve our obvious present patent affordable housing crisis. We were at all-time record unaffordability just in November of 23 and are only slightly down from that. And we're still near very close to large historic gaps between the 30-year average mortgage rate and the 5 or 10-year bond. And as I hope we discuss, the release and recap can address both those things in a very positive way.
Well, let's not even delay. Let's just go right to it, because that's summarizing two of my questions. And let's just go right to it, because again, this is very fascinating. We had lunch the other day, and you were telling Julie and I about PMI, and we were talking about, like, some, without getting into name calling, there's a lot of people that are against the release of the conservatorship. And then I couldn't figure out, given all that I've researched on this, why anyone would want the Fannie and Freddie to stay under government control. And I mentioned some names, and you quickly told me, well, it's because those people in particular have an interest in it staying under conservatorship on a financial interest. So if you could start there, and then maybe we could kind of walk into the other topic you brought up. Like, so if I'm hearing a constant stream, a barrage of people saying it should stay in conservatorship, what's their motivation for wanting to stay in conservatorship, in your opinion?
Awesome, great question. With or without name calling, I'm an attorney. Of course, this is an adversarial system. So I think to your question that someone's biases or their interests should always be fully disclosed. But first, let me start with the broader question that you asked: who is potentially against the recap release and why? And the really only identifiable group that has a significant interest in having it not occur, as you mentioned, is the private mortgage insurance industry, PMI. And as you know, and most of your viewers know, they insure the top 20% of mortgage, between 80 and 100. And of course, unless values are going down, there's no risk. And that's been known for decades. And now what's significant about that is because Fannie Mae and Freddie Mac, I'm sure most of you know, are so large, roughly 55% of the roughly $14 trillion in mortgages, are the $7.5 trillion, give or take, that are insured by Fannie and Freddie. They have become so effective and efficient and built such a wide competitive moat that they could easily, more cost efficiently, that is, for far less premiums, write that PMI insurance. Hence, their recap and release poses an existential threat to the private mortgage insurance industry. You mentioned calling names. I don't think it's bad to call names. So Mark Zandi, an economist, he's been a longtime opponent of the recap and release. He was an advisor to recently the Kamala Harris campaign. And he wrote an opinion piece back in 2015, now going 10 years ago. And he wrote it with Jim Parrott, who I'll mention also in a second. And that piece really wasn't much of a study. It took the position that mortgage rates would go up if they were released at that time. Putting aside for a moment how different the market was in 2015 than now, let's just address those conclusions. Okay, so the GSEs, Fannie Mae and Freddie Mac, government-sponsored enterprises, have two mandates. One is to provide for affordable housing, also known as expanding the credit box. Their second mandate is to provide liquidity to the secondary mortgage market in times of market dislocation. Restated, buying MBS, mortgage-backed securities, when no one else will, like now. Why is it now? Because the two largest buyers of MBS traditionally, the Fed, is not buying because of quantitative tightening, and banks are not buying because of increased capital retention requirements from two things. One, COVID, and two, the mid-level banking crisis, which started in March of 23. So what happens when you take the two largest buyers that are on market to price? We all know that. So when the recap and releases occurs and Fannie and Freddie are allowed to use the capital they now have, approximately $160 billion in capital, to perform their mandate, to buy when MBS, when others are not, their buying power will make the prices of mortgage-backed securities go up and automatically, in lockstep, make mortgage interest rates come down. That has been their buffer role for decades in our economy. Since, in fact,
you said something, and all of our listeners are going to really, it's important that this didn't get by them. By the way, I did some AI searching while you were talking with regards to Mark Zandi. This is from ChatGPT. Mark Zandi, chief economist at Moody's Analytics and board member of MGIC Investment Corporation, a leading PMI provider. The privatization of Fannie Freddie could pose challenges. Zandi has expressed concerns that privatization might destabilize mortgage market interest rates and cost of borrowers. So that's where his stance comes from. So just to validate what Keith is saying, Mark obviously has a board seat with one of the largest PMI companies in the world. So research this yourself, listeners. But you said something interesting. So I think you didn't use the word hypothetical. Maybe that's not necessary. But you're suggesting that with the privatization of Fannie and Freddie, when they're released from conservatorship, that we could see mortgage rates fall, not increase, if I heard you correctly. And also, if the PMI costs were to be reduced as well, the actual payment to the typical borrower will go down as well. And listeners, you guys know that unless the borrower has 20% equity, they're paying PMI. And who is the PMI covering? The mortgage company, not the actual mortgage holder. So it's sort of ironic, the whole thing. So those two things in together could cause actually a drop in effectively what someone's monthly payment would be. Did I hit the nail on the head?
Twice you did. And I won't say might, I'll say my opinion, provided that the GSEs are using their buying power to increase their agency-owned MBS portfolio, it will reduce mortgage interest rates. So we got up to a historically wide level in about November 23 of about a 320 BIP difference between the average 30-year mortgage and the 5-year bond. It's back at around 280 right now, but its average historically is 150. As that spread tightens to normal historical standards, that'll be a reflection of bringing rates down. And the other thing that I would add is so that's an unavoidable supply demand thing. The best argument in opposition to that, this occurring is, well, the rating agencies, when they're released, that will overcome their implicit federal guarantee or backing. And when that's overcome and that's no longer there, they'll be rated lower. And of course, therefore, rates will go up because people will need to demand more interest to hold MBS. Well, that best argument went away a few weeks ago when Fitch reported that they see no reason to change the ratings of Fannie Mae and Freddie Mac if they go public. And there's good reason for Fitch to say that. As I already referenced, they have $160 billion in equity capital. So what sits between the taxpayers ever having to have another bailout is all of the equity on their $7.5 trillion book, plus $160 billion in equity capital. In fact, the former CFO of Freddie Mac, in a great piece for NYU that your readers can find online, Don Layton, he said, the risk of another taxpayer bailout is so statistically low, it's difficult to even statistically measure.
That's
In my view, and our analysis coincides with Mr. Layton's. There's effectively no risk of another taxpayer bailout. Their balance sheet is better than ever. Their balance sheet reflects what the Oracle of Omaha, Warren Buffett, has said. He said one of his greatest missteps in his investing career was not to invest more in Fannie Mae and Freddie Mac.
well, I mean, so that leads, it's kind of an interesting thing. Again, incredible to actually ponder the fact that they needed to be bailed out in 2008, and now 16 years later, they're still in conservatorship, which I know I'd love to have you talk about that. But also it's become, if I remember correctly, the two most profitable companies per employee on planet Earth. And like, as far as like, go ahead, sorry.
Yes. So they've always been amongst and they are what you just said, the two most profitable companies per employee by far. Chevron's the third, and it's not nearly as profitable per employee as the least profitable of two, which is Freddie. Let's go to your really important point. It's really important for listeners to understand why they were put in conservatorship and if they needed to be put in conservatorship. So 3 gentlemen were primarily responsible for that: Hank Paulson, Ben Bernanke, and Tim Geithner. And Hank Paulson famously testified before Congress, and he quipped while he was advocating for the HERA, the 2008 Housing and Economic Recovery Act. He said, if you give me a bazooka, referencing the HERA law he was advocating, I likely won't need to use it. And then about 3 months later, he used it, and he used the HERA law to create the conservatorship of Fannie and Freddie. Now, of course, a lot of other things were going on. The Lehman bankruptcy had just occurred. But importantly, both Paulson and the former regulator of OFEO, John Lockhart, and Ben Bernanke all testified before Congress in or about July 2008 that not only were they then financially stable, but could go on operating in their existing form, meaning they didn't need to be structurally altered. Now, you could say a lot happened in 3 months, but the counterfactual accounting has been done too, which is So the bankruptcy standard is, of course, inability to pay debts as they become due, right? By that standard, the counterfactual accounting, i.e., would they have needed to be put in bankruptcy, something like a conservatorship, had they not been put in conservatorship, came out with a conclusion. The answer is no, that their total losses would have been about $100 billion, that had suffered losses in a couple quarters, but well had the ability to do that. So why were they put there? And let me give you another comment before I answer that big one. Their competitors at the time, Countrywide, no longer, of course. At the time, Wells Fargo, no longer in the mortgage market. Bank of America, JP Morgan, Goldman Sachs, other big banks, they collectively had a greater than 500% default and greater than 500% seriously delinquent loan rate than Fannie Freddie did. So I will submit to you, because I believe it's true, the GSEs did not cause nor materially contribute to the great financial crisis. They had the best, if you will, of the subprime portion of the market. Their underwriting standards mandated it. A number have argued, and there's a great, this is what I'm about to tell you. It's historically important. It's a very interesting academic analysis. It no longer pertains to what needs to occur now or what's best for the market now. Having said that, I'll tell you, there's really good evidence for the proposition that they were put in conservatorship. Well, they probably didn't need to be there. So their enormous, successful, positive balance sheets could be utilized by their government to take care of other very, very significant problems of the great financial crisis, namely the Lehman bankruptcy then and now, the biggest bankruptcy in the history of the world.
Let me interrupt you. So right there, that's the great makings for a Netflix series, what you just said, right? I mean, it's incredible. And they still kept, you told me this, and I didn't know this, that they were essentially still sweeping the profits up until 2019 to Treasury. And I mean, didn't mean to interrupt your story, but really, I think really this gets to the heart of it. What the hell happened to the damn money? And the money was essentially absconded with and being used for other things. I mean, I'm hopefully not using attorney words that are making you squeamish, and that is in essence what you're describing.
Let me address the history. It's really important, and it's I believe, fascinating and important to understand. Let's first take 2008 to 2012, and then we'll take it 12 to 19. So in 2008, there was a preferred stock purchase agreement created between the two parties, FHFA, Federal Housing Finance Administration, and Treasury, the only two parties to it, and the only two parties that today, in Feb 25, need to sign off on a potential recap release agreement, just as another letter amendment to that PSPA. Okay, so the original dividend, they called it, that was payable by the GSEs to the Treasury was for 10%. And that went on for those 4 years until 2012. And then in 2012, you correctly stated that on that year, what's called the net worth sweep began. And it happened in August 2012. And in Q4 2012, Fannie and Freddie posted the single largest quarter of profits in world history, $63 billion in one quarter. Why? Because the Treasury and FHFA, working in concert with Treasury, went out of their way to make them look far less profitable than they were. They did that two ways: by having extremely high loss reserves and by utilizing other expense mechanisms to ratchet up the liability side of their balance sheet. When those things were unwinded, they posted those gains. But immediately before that Q4 in August 2012, that's when the net worth sweep began. And for every quarter from 2012 through when Mark Calabria, Donald Trump's FHFA director, was appointed, and he and then Treasury Secretary Steve Mnuchin unwound the net worth sweep and stopped it, 100% of the profits went to the Treasury/federal government. Now, I said the original dividend was 10%, so what they called it, and net worth sweep was a 100% dividend. Think about that. That the government took all the profits for 7 years from two of the most profitable companies ever. So how did it work?
It's important to note too, right? These were private companies. The government essentially took over two private companies and took the profits, in essence.
So A lot of people would, have interesting discussions about that because they're government-sponsored enterprises. Fannie was created by FDR in the 1930s. LBJ created Freddie Mac in the early 1970s. It did its IPO in the early 1970s, and so they would. The suggestion is because there's an implicit backing that they're kind of quasi-government entities. But you're right. They are private. They're privately held shares. And now let's go on with the math. So because of that net worth sweep, I said there was a dividend. You could also think about it correctly as a loan. That is, Treasury and our government lent Fannie Mae and Freddie Mac $191 billion. And they got back about $300 billion. That is, they profited $110 billion off that relationship from 2008 through 2019. Okay. And they have a big decision to make when they recap and release, whether they write off or convert what's the created $290 billion, $300 billion of Treasury senior preferred shares. If they write it off, it's probably worth more to the Treasury, as Bill Ackman has recently advocated, and the former CFO of Fannie advocates, Tim Howard, or they convert the senior preferred shares. If they do that, Treasury and government, they convert them into common, they're paying themselves a second time in a major way. Because I've pointed out, they've already profited $110 billion. A easy way to think about that is, as profound as I think it is, it's the best deal of the great financial crisis, and it's likely the best deal the American government's ever done, perhaps excluding the Louisiana Purchase and the purchase of Alaska. So is it relevant to bring up in relation to this arguably quasi government entities who were and should again be private, that they've already been paid? Yes, it is worthy of bringing it up because they can get paid a second or third way. And that second or third way is the Treasury owns penny warrants into 79.9% of the common, which means they're going to wind up owning roughly 80% of the privatized GSEs. And what are those penny warrants worth to the Treasury? Well in excess of $200 billion, a similar number. Okay, so hence they get paid a second time if they write off the senior preferred shares, or a third time if they don't. But again, myself, Bill Ackman, and Tim Howard all believe that the government stake is worth more if they write off the Treasury preferred shares. Why? Because they need to raise money. Right now, only, I use air quotes, $60 billion, which is a gargantuan IPO. But for companies that average $25 billion a year in profits, for them, it's actually not that big. It's very doable. So how do you attract new capital in these ongoing enterprises? Do you decimate the legacy common, which would occur if you convert the Treasury senior preferred shares into them? Or do you get good, treat the market correctly after you've turned off their dividends since 2008, their non-cumulative dividends that pay on the junior preferred shares of Fannie Mae and Freddie Mac? At today's interest rates, roughly 8.7%, the most liquid of the 40 sets of the junior preferred shares would pay that. So you should look at it this way also. An amazing fact is, back to why they were originally put there, or if they needed to be put there. In the 12 months before the conservatorship began in 2008, of the $32 billion of face par and paid value junior preferred shares, more than half of that was raised in the 12 months preceding the beginning of the conservatorship. What? The 12 months before September 2008 are likely the worst economy of anyone on this call's lifetime. That's how valuable the market deemed an investment in Fannie Mae and Freddie Mac. Not only were those junior preferred shares sold to banks around America as pristine collateral upon which they could lend, but moms and pops all over our country made extremely safe investments in those junior preferred shares because Fannie Mae and Freddie Mac are SIFIs, the systemically important financial institutions, no lower than JP Morgan, Morgan Stanley, Goldman Sachs to our economy. They cannot be allowed to fail.
Yeah, I mean, so long you were talking about, I was following you on three different things. Hold on, I have to have some coffee to keep up with you. My brain's getting a little tired.
It looks good.
Yeah, Julie made it for you.
Oh, nice.
So what has to happen before release? Because listeners, if you're not following along, what he was talking about was hypothetically what will happen to the value of the junior preferreds and the common share equity. And I don't know if you want to talk about that or not. I mean, that's from an investment thesis or investment perspective. And I should have said this at the top. Julie and I are invested with Keith in this fund, so we're long in it too through Keith. But the moral of the story is that if you look at, for example, what the equity, say, for example, a share in the Commons FNMA was trading for prior to going to conservatorship, wasn't it in the 50s or the 60s?
The answer is it's been the 30s to the 50s. The answer is the average price to earnings ratio of Fannie Mae and Freddie Mac combined on average is about 13 PE pre-conservatorship. So I won't go into specific ROIs, but I'll respond to your question. There's a completely different risk benefit analysis to owning the junior preferreds or the common beneath that. The junior preferreds, as I've already mentioned, when dividends are reinstated, if and when, and we believe when, because we're going to get into hopefully how it will occur and when.
Next question.
Yeah, sure. They will highly likely trade above par on yield alone, because what's more valuable, a junior preferred share that will again pay 8.5 to 8.8% interest, something in that range right now, or a T-bill bond or note paying roughly 0.8% right now.
Okay, so par on a junior preferred, let's say it's $25, and right now it's trading for less than half of that. And you're suggesting that it's going to trade for above par because obviously the 8% dividend yield will make it more valuable. And that's a really good dividend yield.
On yield alone. The
Yeah.
commons, for reasons I didn't reference, but for reasons I reviewed, which was the Treasury makes its decision to write off the senior preferred shares. That would be a great day for the common. But if they convert to senior preferred shares, it would be a bad day for the common because it would decimate them. It would make their value go to zero or really close. And we believe that if the Treasury picked that punitive option for no need, they would definitely end up owning more than 80% of the combined entities. And that would risk putting some or all of the $7.5 trillion in GSE debt on the government's $33 trillion in debt. Not a decision to be taken lightly. And we believe it's the less beneficial one for Treasury. And it's also the less beneficial one for all the banks. And
So let me break that down. So you're saying, because this is the first time I've heard you say this, you're saying that the biggest reason why that the government won't essentially zero out the commons FNMA is because they would end up owning basically the entire company at that point. And then they would be assuming that would be essentially a $7 trillion potential liability on the government's balance sheet. Did I say that correctly?
I'd just change this a little bit. The government would own between 90 and 95% of the combined entities if it converts to senior preferred shares and risk adding $7.5 trillion approximately to our $33.5 trillion debt.
That sounds very un-Trump-like thing to do and very un-Doge-like thing to do.
So the DOGE, the Department of Government Efficiency thing to do would be to have the Treasury's interests be more valuable by writing off the Treasury senior preferred shares. And it would be to use the over $200 billion, which will be created by the Treasury's exercise of its penny warrants into the common for effectively whatever the deal maker wants to use those monies for. Our president could use them for solving the supply side housing. There's plans of the Brookings Institute to create Brookings Institution to create a supply side trust fund to help solve that. As you know, Tim, we have a shortage of a low of 3, maybe as many as 5 or 6 million homes in America that need to be built. And Bill Pulte, our recently nominated director for the FHFA, a third generation home builder, the second largest home building company in America, certainly would know how to help utilize these funds to build much needed housing. Second, he could alternatively use these funds to pay down the deficit. He could use these funds as a pay for to extend tax credits. Amazingly, the recap and release does not require legislation, does not require a vote, and does not require that it even go through the House Appropriations and Means Committee.
Okay, so I'm sorry for interrupting you, but I've heard all kinds of stuff about it has to be approved by Congress.
It's wrong. So I'll give you some sources in addition to me because I've studied it. Mark Calabria, Donald Trump's former FHFA director, published, and I've spoken with him. He knows it does not require legislation. In fact, he was a Senate staffer working on drafting the very law HERA that makes clear that no congressional action is needed to allow them to go to recap release. French Hill, an ardent advocate of recap release, knows this. I'm effectively certain that our new Treasury Secretary, or soon to be, Scott Bessent, knows this.
Yeah, makes sense. So what has to happen for release? What do you think the next steps, and if you wanted to really go out ahead of your skis, what do you think the time frame is for release? Or at least start with the announcement and then the company's made private again.
I won't go for the crystal ball second question. I will go for the first question. So what needs to happen is very simple. So I mentioned the preferred stock purchase agreement. A simple letter agreement signed by Bill Pulte on behalf of the FHFA and Scott Bessent on behalf of Treasury, amending that existing PSPA, could be 3 or 4 pages, that announces the recap release could do it. Mark Calabria has pointed out a number of times in his book, Shelter from the Storm, a worthwhile read, and in public forums, that he, while FHFA director, and Steve Mnuchin were working on the recap release profoundly during the COVID summer. We're all worrying if we could go outside or touch the same light switch someone's touched, and they're working daily, his words, on recapping and releasing the GSEs. They had it ready to be done by end COVID summer, August 2020. And they received instructions from the first Trump administration not to do it until after the election and to try to get it done pre-inauguration. The election result happened. Steve Mnuchin was off in the Middle East raising money for his new fund. J6 happened, which of course made it less likely to occur. And so they left the ball on the 1-yard line. So Mark Calabria has pointed out that all the work is done. It simply needs to be dusted off to effectuate the recap release. But it could literally happen with a stroke of a pen. And our president could certainly sign an executive order directing the Secretary of Treasury and FHFA director to make this happen, or it could be a 3-way signing party.
So just so everyone understands, Trump did, in a letter to, was it Ron or Rand Paul, very clearly state that he thought that they never should have gone to conservatorship in the first place and they should be released. So that was and then yesterday, I think it was Jerome Powell, who runs Treasury effectively. He basically said, there's no reason why it shouldn't be released. So essentially what we're seeing are all the dominoes starting to fall in the direction of a release that's going to happen. So procedurally, you're saying Trump would just have to sign something saying it's going to be released. It does seem like all the people that he's put in place in his cabinet are in alignment with that particular goal. I did hear Bassett, how do you pronounce his last name, Keith?
Bessent, I believe.
Okay, yeah. So he's the one that said that the only reason why there wouldn't be a release would be if he thought interest rates were going to go up. Can you address that?
I watched the interview, and I also know about that he has analyzed these companies in the past as a private citizen and very successful hedge fund manager. And given that I watched his interview, what he said was that the most important metric he'd be focused on is this, and it raises it's a great question for additional reasons, Tim, and those are these. We're experimenting about a rate increase that can't be studied because this release has never happened. But I'm confident Scott Bessent knows the market and the supply and demand metrics that I reviewed. And I'm confident that Scott Bessent knows if he chooses to expand the agency-owned MBS portfolio, that will by definition bring down rates. So he mentioned finding an academic study or wanting to have one, right? And so one doesn't presently exist because it's a test tube that hasn't occurred yet. That in mind, I'm confident he gets it. And let me also address what you said about President Trump's letter. It was to the younger Rand Paul, and it was very important, the context, because it goes to why I told you our president need not even sign an executive order. The letter stated to Rand Paul was addressing a question left open by our U.S. Supreme Court, who in 2021 gave our presidents power that they never had before, specifically the power to terminate the head of the FHFA at will, not for cause. So President Trump was addressing a question left open by the U.S. Supreme Court. And he said, had I, the prior administration, had that power, I'd have exercised it. I'd have terminated the democratically appointed FHFA director, and I would have immediately recapped and released the GSEs from conservatorship and sold the government's common shares at a huge profit. Those are his words. So we know from that letter what our returned president's intents are regarding this, and we know from multiple sources, Wall Street Journal approximately 2 months before the election, and 10 I could almost think of right now since the election, provide further evidence that this is the direction they're moving. So again, I won't try the crystal ball on you, but there was, for example, reporting shortly after the election that it was potentially going to be a first 100-day priority. Now we all know running the White House is like a triage, so priorities appropriately change with other things going on. That said, it could be that soon.
Okay, so why wouldn't this happen? Why wouldn't they be released? So we've talked now for 37 minutes about why they should be released, the history of them, the rest of it. So what's the argument against them being released?
Yep. So I gave you the only identifiable counterparty, if you will, or opponent, the PMI industry. But let's address people who might be in favor of the status quo. And both PMI and let's call them the status quo proponents frequently say, well, we're only in favor of this if we have a legislative guarantee of their book of business, $7.5 trillion, that put the government on the hook, then we're okay with it. And then interest rates won't come down because then the market won't think otherwise. But we just heard from Fitch that argument's not true, because they just said they see no reason to change the rating if they're released. But let's get back to it. So what is the difference substantively between the requested legislative backing guarantee of their book of business and what's existed for the last 16 years? And what is that? What that is about $250 billion of government backing through the preferred stock purchase agreement. Is there a substantive difference? The answer is no. They're both backing. In other words, it was in a statute or it's an agreement that doesn't make the Treasury more likely to comply with it, period. So the market's been just fine for the last 16 years with the present backing. And would that likely continue, a PSPA backing like that? Yes. And the government would likely be compensated for that. So about 90% of the GSE's profits are from guarantee fees or G fees, presently about 55 bips of each mortgage. A portion of that or a additor to that could compensate the Treasury for continuing that backing, paying that, it's called periodic commitment fee. So that fee could be built into the recap. And for those concerned, they say, well, if they're allowed to go private again, they'll be allowed to take on too much risk. We might get in problems like happened in 2008, which I've already explained, were not primarily the GSE's problems. They were their competitors' problems. Remember, 500% greater default rate, and their competitors, not them. So their argument is, well, we can't privatize them. Well, the FHFA can continue to maintain whatever types of control the Treasury and FHFA, the only two parties, deem appropriate going forward. In other words, they can privatize them and still give them strings to be able to decide on who's your directors and officers, what compensation should be, and other matters that they've had effective complete control over for the last 16 years.
Didn't Jamie Dimon suggest that he would like JP to get back into this, do essentially what the GSEs do? Didn't he suggest that if that were a possibility, if the playing field were more level, that he would start consider becoming a competitor?
He did. He did make comments akin to that, and it's a really great question. Here's why. So I mentioned they have 55% roughly of the 14 trillion roughly mortgage market in America. So a lot of it also is FHA, VA loans, and then there's of course private label mortgage-backed securities. And of course, JPM is a major private label mortgage issuer. So to step back just a moment again, what is clear evidence for the proposition that Fannie and Freddie are here for good and should be, because their product, the 30-year fixed rate prepayable mortgage, is the single most important product to economic equality in world history.
Let me interject because this is important for the listeners to know. So unless you know different, you might very well, the United States is the only country in the world where you can get a 30-year fixed rate mortgage. And that's
really close. I'm a little bit Danish, and there's about 8 million Danes. Denmark has it too. So 350 million of us, 8 million Danes. And the reason absolutely is Fannie Mae and Freddie Mac, because as most of your listeners know, from the lender's perspective, it's a horrible piece of paper. So what Fannie Mae and Freddie do, of course, they don't make loans.
But Keith, remember our audience. So it's a horrible piece of paper because they're locking themselves into holding a note for 30 years at an interest rate, which actually might be lower than what they could have gotten if they had, basically whatever the prevailing rate is 5 years or 10 years from now.
Precisely, because the lenders would never accept that interest rate risk over that term. So they don't make loans, they secure loans, they bundle them, they securitize them. And then the only risk the holder of MBS has is prepayment risk. All the credit risk is on Fannie Mae and Freddie Mac, hence the need to have conforming loans. So back to my thought. You had between 2008 and 2015 what we call the mortgage wars, times where the JP Morgans, the Bank of Americas, the then Countrywides, the then Wells Fargo were frequently proposing legislation to get rid of them. But in 8 years, 8 to 7 years, 8 to 15, they never came up with a viable alternative to Fannie Mae and Freddie Mac, meaning anything that should replace them, a different form. And they had, as stated for different reasons, a $25 billion a year profit incentive to find that for them. Because of course, who like Countrywide or JP Morgan or Bank of America wouldn't want a slice of that pie? They all did. And they were in 8 years never able to come up with a viable alternative to them. So now, because the net worth sweep ended, they built $160 billion in capital, are far more fiscally and financially sound than ever. You should require, if you have anyone on your show, either suggesting that interest rates will go up or that this will lead to another taxpayer bailout, to give you evidence of that, because I've presented to you reasons why we believe that the risk of a taxpayer bailout is so minuscule it's hard to measure, and we believe the likelihood that interest rates will go up is also small if they expand their agency-owned balance sheet.
I'm trying to be sensitive to your hard stop because I know you have another Zoom. So as we wrap up, agents that are listening, brokers that are listening, a lot of mortgage professionals listen. We have, just all kinds of different folks in the real estate industry that are listening right now. What would be the main big takeaway you want them to have from what we just discussed for the past bit? What would be something that you'd want them to understand?
I'd want them to understand that I believe it's in every broker and mortgage originator and lender's interest in America to have Fannie Mae and Freddie Mac released from their conservatorship, because the conservatorship strangles their ability to perform both their mandates. One, affordable housing, which means more housing. The average FICO score pre-conservatorship was approximately 680, 700. The average FICO score in their $7.5 trillion book of business is 754. The average loan to value ratio is 54%.
I'm sorry to interrupt. So listeners, what he just said was pre-conservatorship, the loans that they were holding and the debt to income ratio, or the amount of equity in the properties, was completely different than it is now. So that the portfolio of loans that they've in essence insured, the borrower's credit is through the roof by comparison, over almost like 100 points. And also there's obviously a lot more equity in the house, especially if they've owned the home for the last 5 years. That's completely changes the arithmetic when you're looking at the risk of these companies.
Meaning they have a fortress-like balance sheet and a pristine book of business, meaning they can and should use their enormous balance sheet to make tens of thousands of additional loans to workforce housing borrowers in America who are obviously good credit risks. There's approximately 92 million Americans who have FICO scores between 650 and 750, many of whom have been denied housing for the last 16 years because of these conservatorships. So that's why it's good for everyone in real estate if the recap release occurs. It secondarily makes it good because when they're able to perform their second mandate of providing liquidity to the secondary mortgage market in times of dislocation, buying MBS, that will bring interest rates down. The more they buy, the more they'll bring them down. They can literally control it because of their enormous balance sheet to do what they had. Pre-conservatorship was a much greater balance sheet.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.